I think you have to look at two things. I think that you have to segregate between volatility and cyclicality, and natural resource markets expose you to both. If you have been around financial markets as long as 49 years now for me, you come to understand that resource-based markets are both cyclical and volatile. I suspect that the financialization of all asset classes that you describe probably over time increases volatility. There isn't much that happens in terms of financial markets that ultimately can change the nature of the cyclicality. But remember that these markets are capital intensive, very cyclical, and both the upside and the downside over time of price movements in natural resources is extreme relative to other classes. The volatility, I think, is partially a function of the financialization of markets, but I think it's also the function of rapidly converging big economic issues. I think it's important not to confuse volatility with cyclicality, which are very, very different things.
So, or as an investor or a speculator, how do you plan for an exit strategy given the volatility?
I don't think about them, to be honest, Aditya. I'm a position investor, meaning that I develop an outlook around a commodity that envisions as many long-term facts as I can gather. And I'm unlikely to change my strategy except in the face of extreme price movements. Extreme price movements down cause me to be a buyer. Extreme price movements up cause me to be a seller. Now, that might mean that I'm perpetually uncomfortable. It's difficult to buy when your thesis is being tested by declining prices. It's tough to sell, too, when the sell-side thesis is being contested by all kinds of bullish price action to the upside. But that's what you must do. My investment strategies are always guided by valuation strategies. And I regard volatility myself is at most a tool, which is to say, if the idea around investing is to buy low and sell high, occasionally volatility gives you the ability to do either in a much shorter time frame than would otherwise be the case. So I can be an opportunistic trader around volatility, but it doesn't really impact what I'm doing with a core position. If, as an example, I owned $1 million worth of silver equities, and the silver equities were to give me unexpected upside in the near term, it is not unlikely that I would sell 30 or 40% of my junior silver mining portfolio, the same way, Aditya, that you saw me a year or a year and a half ago deal with my junior uranium stocks in what was to me an unexpected uptick. Similarly, around my various commodity theses, I always try to develop a shopping list, which is to say companies that I'd like to own in varying circumstances. And to the extent that the performance of the commodity and the commodity-related equities is disappointing the markets in the near term, I'm much more inclined to be a buyer than a seller. It's important, I think, in this context to remember the old Wall Street ditty, stocks climb on a wall of worry, which is to say when the fundamentals are in place, but people aren't buying because the price action is bad, they're worrying about the price action, that's normally a fairly bullish situation. Stocks slide down the slope of hope, which is to say when people are hoping for higher prices, particularly when they're heartened around a thesis, you often are in for tough times. considering the silver market, one needs to understand that it's an atypical commodity. In the first instance, it is partially a monetary metal. Silver has been used as a store of value and a medium of exchange in many, many cultures over a very long time. And in that case, many investors and speculators look at it as a monetary metal, as a lower priced, more liquid substitute for gold. By the way, more volatile too. Silver is also an industrial material. It's critical for things like water and wastewater treatment. It's critical as a reflective component of solar energy and other technologies like that. Some years, 1 billion ounces of silver gets used up in those activities. It's a strange commodity too, Aditya, in that primary silver mine production, which is to say mines where more than 50% of their revenue come from silver, generates between 18 and 20% of silver supply. So while silver is critical to silver mines themselves are much less critical to the supply of silver than recycling, and in particular, byproduct production from things like gold mines, copper mines, lead mines, and zinc mines. Because demand for silver is both monetary and industrial, it's difficult to gauge demand by traditional metrics. You have to figure in both. And because so much of the supply of silver comes about as a consequence of mining for other materials, looking at all-in sustaining costs around silver miners is less instructive than it might otherwise be. You have to understand the economics of copper mining and lead mining and zinc mining, and look at the unit production of silver that will occur as a consequence of mining other metals. The other thing about the silver market that's always fascinated me has been the role that the Indian subcontinent plays in silver. The Indian subcontinent has functioned for decades as a silver sink in ways that often baffle Western analysts who have less sense of what's happening in India than they might otherwise were they studying silver supply and demand. So I would suggest to you that silver is a commodity that is more difficult than most to develop valuation patterns around. The third thing, and I'm sorry for this long-winded answer, Aditya, but it's a very big question. The third thing that people need to remember about silver is that, at least in terms of its speculative component, that in the last two precious metals bull markets, silver has been more a late cycle mover than an early mover. It would appear that speculative demand, investor demand for silver, and when I say speculative demand, I'm talking about demand ex-Pakistan, Bangladesh, India, and Sri Lanka, which are special markets for silver. But speculative demand for silver in the West and the developed nations seems to occur after the momentum has already been established by gold. It would seem that the gold buyer is a fear buyer and the silver buyer is a greed buyer. So that once the fundamental trend in the direction of precious metals is up, gold moves first, but then silver moves further and faster.
There were a couple of things you said in there that stood out, and in my original question, I was trying to see if you quantify your exit strategy, because valuations will change depending on how high you think silver will go. So as an example, in 2019, silver prices were 20, in 2020, they were 30. So you can argue that the silver stocks were expensive in 2020, and so they should have sold off if your long-term price forecast was 20 or 25. So given the comment that you made about the market being difficult to quantify and almost irrational in a sense, how, as a disciplined investor, how do you apply the principles that you talk about regarding price and value in the silver market and silver stocks?
every stock in my portfolio has a very rudimentary valuation calculation in my file, generally handwritten, generally no more than 2 pages of scribble. And part of the scribble, if I have a big enough position, involves net present value calculation, a very rough one, in a variety of pricing scenarios. In the case of silver, I'm currently running a $15 case, a $20 case, and a $30 case. Meaning that I try to quantify for a downside, for a stasis side, and for an upside. I also, in the case of silver, because it's so volatile, run myself a shadow $50 case, so that I can take into account, and I don't give it much credence in my valuation, but I can take into account the incredible benefits that one might accrue as a consequence of optionality. In other words, if the silver market really, really did something. Nowhere in my valuation do I do any sort of calculation around the impact of a narrative on a story. In other words, I don't account for boredom and I don't account for elation. What I'm trying to do in this circumstance is give myself a sort of a base case to invest and trade around, knowing that I won't be right ever, but knowing that I will be more right over time than most people who don't go through the effort.